the market. Rahul, hi. Thanks very much for joining in. Well, everyone's thinking if they can carry their own food to PVR and INOX and all of these theatres. What's your sense? You've been a long watcher of both of these stocks. Do you think that earnings are going to be hit materially once this comes through?
So thanks for having me, Ekta. I think there are two aspects to look at it. One is the valuation aspect, and then the other is the core earnings growth if this comes through. Purely from a valuation standpoint, INOX is down to single digits price to earnings on FY20. I think it's about 9.5 times. EV/EBITDA is less than 5 times. PVR, which used to be somewhere between 25-30 times price to earnings, has come down to about 18-19 times, and about 8 times EV to EBITDA. PVR's got hit more than INOX in this fall. Your specific question, yes, earnings will have to be reworked because if you see the food and beverage side of the business, that's about a 70-75% gross margin business. And the advertising part of the business is about a 90-95% gross margin business. The box office is actually the lowest. You get about 50-55% gross margins from the box office. So if almost 15 to 20% of your revenues was coming through F&B, which was a 70-75% gross margin business, and you have to cap prices or allow outside food, which is in effect telling you to control prices, it will definitely have a bearing on the earnings. The bigger problem I have, Ekta, is and this is a society philosophical point, is the extent of regulation that's coming into various sectors, and it's becoming difficult to call as to what the fair value should be. So you've seen a flip-flop on electrical vehicles, you've seen a flip-flop from the government on overloading with respect to Ashok Leyland. Now you have this. Obviously the multiplexes are going to contest it, but as we were discussing with Prashant in the break, it's very difficult to ascribe a price to earnings multiple when you don't know what the earnings are going to be if you're going to have so much interference. Obviously, we will have to downgrade it if it goes against. But if you just see Q1, there have been about 3 or 4 movies in Bollywood that have crossed 100 crores. There have been 1 or 2 Hollywood movies and a couple of regional that have done well. So I don't think if you strip out Bahubali, which was obviously a once in a decade kind of a movie, if you will, the Q1 results should actually be pretty good, according to me, if you take out that effect, because the ad rates are actually going up pretty well. In fact, we are forecasting INOX's EBITDA between 18 and 20 to grow at twice the rate that PVR's does. So structurally, I think this is a non-substitutable industry. I don't think Netflix has picked up to that extent in India just yet to dent the business model. But I think if things like these pop through, it's very difficult to take a call. If you're playing it fundamentally and you have a 2 to 3 year view on this business, which is, I still think, going to be fairly nascent even 3 years out from now, I still think it's a buy, and I think it's far more attractive today than it was, say, when the last time we spoke about a month and a half back. But the regulations notwithstanding, I would still say go in and buy a PVR and an INOX even at this price, because I don't think at these valuations there's too much to lose even from here.
Rahul, but have you sort of spoken with legal experts on this entire issue? Because there are people who say, who are on both sides. They say, well, you're in the entertainment business, why should you regulate what food is available, etc.? I mean, some say this is populist, they're trying to push it, I mean, be populist with the people, and if there's no legal basis, so it'll be thrown out eventually. Have you sort of dug a little deeper? Where does it stand?
So we spoke to the managements of both the companies, and obviously they're not going to say anything, because both their numbers are not out yet in the open. But there's another way to look at this, Prashant, because if you see INOX now, especially with their new offering of Insignia and the restaurant format that they have, you can actually purchase F&B in INOX in India anywhere, even if you're not watching a movie at INOX now. Yeah. So basically what you've done is you're now regulating restaurant prices. So the question is, where does this stop? To take just one word that you use, populist. So are you going to regulate hotel prices and hotel tariffs and restaurants next? I'm not saying it's a bad thing to do. I mean, paying $100 for a bottle of water may be obscene. But to what extent do you want to regulate? And as a market participant, how do I start valuing these things?
If this does come through in your conversation with the managements, can they compensate this by higher ticket prices?
You'll land up with the same issue there. At some point, they'll come and regulate that.
We already have capped ticket prices, I think, in Tamil Nadu.
Absolutely. Right? So there is flexible and dynamic pricing, which is if you charge prices at a particular, if I'm charging a particular, let's say a Dangal comes through and I charge 1,000 rupees at Insignia for a 9 to 12 show, then I cannot have differential pricing for that 9 to 12 show in different markets. 1,000 is where it's capped. So to some extent, you already have that price cap that is there on ticketing. But I don't think with the way people are coming down on this sector, there'll be too much much pricing power. There'll be, if this goes through as is, I would not be surprised if our numbers get cut by 15-20%. Would it still be a buy? I think it potentially could still be a buy, but were this overhang to go away, you know, like we've been discussing in pharma,
then there's
a short covering rally that will come through and you'll probably recover your price.
Okay, quickly, Rahul, we're running out of time. Ashok Leyland, it's moving more towards its 52-week low as opposed to the 52-week high. Good time to probably pick it up?
Absolutely. Again, you know, another instance of a government flip-flop on a particular policy, and I don't think investors should be penalized. I mean, I think these things, honestly, this may be a very non-consensus view and people may not say it as directly as I am on your show, but I don't think, I think the government should keep in mind that this is retail investor money coming into the market. You need to be a little more decisive in your policy making, and you can't just come around, you know, Ashok Leyland was 40% higher just about 15 days back, and someone who's putting in money is his hard-earned money. But the question is, we have downgraded our numbers on Ashok Leyland. We were expecting a 14% earnings volume CAGR. That's come down to about 10-11%. Proportionately, our upside on the stock, which was about 30%, has gone down to about 15-16%. But again, Ashok Leyland is coming to you at about 12 times now. You know, there are not too many companies at that market cap coming to you at about 12 times. The results were fantastic. I don't know if you guys had a chance to delve into the numbers, but the kind of results that they have shown, holding on to 13 straight quarters of double-digit margins, a franchise like that, which is looking to reduce its dependence on trucks, which was about 75% last year, stated policy to bring it down to 50% in the next 5 to 7 years by focusing on aftermarket, defense, spare parts and the likes, I would be a buyer. I think if you're wanting to pay the MHCV and CV cycle, even though they've lost a 4% market share to Tata Motors, again because they did not discount, which is again a position of strength to be bargaining from. At this price, I'd be a buyer in Ashok Leyland. Any price below this, I'd just keep adding.
All right, Rahul, thanks very much for dropping by and good conversation as always. You know, there was a flash at the bottom of the screen that the Shiv Sena has also decided to abstain from the no confidence proceedings. So that is BJD and now the Shiv Sena both. Shiv Sena is one of the largest allies of the NDA, and